Capital losses are a great way to help you cut your tax bill. Plummeting stock prices can cast a dark cloud over anyone's finances. However, at tax time, the write-offs for these capital losses can be used as a ray of sunlight. So if you sold any .com dogs or biotech blunders at a loss this year, you can use them to offset gains from more successful ventures or even a portion of your everyday income. What is a capital loss? A capital loss is the result of selling an investment at less than the purchase price or adjusted cost basis. Any expenses from the sale are deducted from the proceeds and added to the loss. The key point is that capital losses are only losses after you sell them. A stock sitting in your portfolio with a deflated price might cause you distress, but it does not factor into your tax issue. The sale of personal use property such as a car can be deducted at a capital loss. You can recoup a percentage of true loss from the taxman. This is one of the best deductions available to investors. A capital loss directly reduces your taxable income, which means you pay less tax. It makes for a nice consolation prize. And how does this work? It's touching that the IRS wants to give you a break when the stock market tanks. However, this does not mean the weighing and applying of capital losses is simple. When filing a Schedule D form, you'll discover that losses are categorized as short-term and long-term, just like gains. The value of the deductible loss depends on how the loss is applied. Sadly, traders don't get to choose. Here's how it works. Short-term losses counterbalance those expensive short-term gains. What's left at the end of Section 1 of Schedule D is the net short-term capital gain or loss. If there were no gains, then this obviously would entail that net would equal the total loss. Long-term losses are applied to short-term gains. The result at the end of Section 2 of Schedule D is the net long-term capital gain or loss. Again, if you only have a loss, then